Welcome to Holman HR's video alert series, the Affordable Care Act Final Regulations Review. In this review, we'll be discussing which employers are required to comply with the ACA and what are the possible penalties and how is the determination made as to whether an employer is required to comply. We'll be issuing short 15 to 20 minute videos explaining different aspects of these final regulations. So let's get started with the first segment. These final regulations apply to large employers, generally meaning an employer that has 50 or more full-time employees and includes full-time equivalent employees. We analyze the number of employees looking to the prior year. Under Section 4980H, a large employer that, for any calendar month, fails to offer its full-time employees health coverage that is affordable and provides minimum value may be subjected to an assessable payment, also known as a penalty, if a full-time employee enrolls for that month in a qualified health plan for which the employee receives a premium tax credit. In essence, a company who's required to comply with the ACA but does not, resulting in employees, for example, using the exchanges and possibly getting tax credits, will subject those employers to penalties under the law. Let's start with some basics. Determining large employer status. As you see, it says reference to slide 6, and we'll be covering that in this segment. But to start, full-time employees plus full-time equivalent employees, sometimes referred to as FTE, equal the total number of full-time employees. Again, this is the calculation an employer must use to determine if it has the requisite 50 full-time employees, of course, or greater. The number of full-time equivalent employees is dependent upon the total number of hours of service, including non-full-time employees. The basis for an assessment or penalty under Section 4980H. An employer will be subject to an assessment if either 1, the employer fails to offer its full-time employees and their dependents the opportunity to enroll in minimum essential coverage, also known as MEC, and any full-time employee is certified as having received a tax credit, or the employer offers an opportunity to enroll in MEC and 1 or more full-time employees is certified as having received a tax credit. You'll see the term certified or certification come up along with the number section 1411. That represents an employee who went into an exchange and purchased insurance on the open market and was determined to be entitled to a tax credit due to the employee's financial circumstances. When an employer is notified that an employee received that kind of a tax credit, that triggers a penalty under Section 4980H. Let's start with the 2 basic sections that describe the penalties a non-compliant employer can face under the ACA. Under Section 4980H sub A, the penalty is equal to the number of all full-time employees, excluding the first 30, multiplied by 1/12 of $2,000 for each calendar month. The penalty under Section 4980H sub B is based on the number of full-time employees who are certified to the employer as having received a tax credit with respect to the purchase of health insurance on an exchange, multiplied by 1/12 of $3,000 for each calendar month. Of note, in no case may the penalty under Section 4980B exceed the maximum penalty under 4980A. So let's take a brief example to illustrate how these penalties can apply in the real world. A restaurant 50 employees fails to provide coverage and receives 30 Section 1411 certifications, meaning 30 of those employees receive tax credits when purchasing insurance on the exchanges. That employer will face a penalty on 20 of those employees because the law will discount the first 30. So they will receive a penalty on 20 of those employees at $2,000 per employee for the entire year. Runs to a total of $40,000. Again, that's the penalty under 4980 H sub A. But in addition to that, because the employer received these 1411 certifications indicating tax credits received by some of those employees, there's an additional penalty. 30 of those employees received those tax credits. At $3,000 per employee for the year, that's $90,000. But as we stated above, the penalty under 4980B cannot exceed that received under 4980A. As such, the $90,000 will be reduced by $50,000 down to $40,000. When added together, the two penalties total $80,000. Each month for each employee, the penalty is $333. This is a very good illustration of why it is prudent for an employer who's thinking about not issuing health coverage for his employees or her employees to take a deep breath, take a look, and do some analysis. This restaurant owner might want to think whether not offering coverage to the employees was worth it in light of the penalty. The difference between the actual provision of healthcare benefits through this restaurant compared to the penalty imposed is probably not that great. The benefit the employer receives from offering the coverage to their staff likely far outweighs any small difference between a penalty and the actual premium dollars the employer would have to pay out. Under the ACA, there are three fundamental elements that will determine if an offer of coverage was actually made. Those elements are minimum essential coverage, sometimes known as MEC, minimum value, sometimes referred to as MV, and affordability. MEC, MV, and affordability all relate to the determination of liability under Section 4980H. An offer of coverage will not be considered made unless it is MEC. Even if coverage is MEC, if a full-time employee purchases coverage on an exchange and receives a tax credit and the coverage offered by the employer did not provide MV or was not affordable, then the employer is still subject to a penalty under 4980H. A plan in the small group market satisfies MV if it meets the requirements for any of the levels of metal coverage on the exchanges, bronze, silver, and gold. Minimum value is when the plan's share of the total allowed costs of benefits provided under the plan is less than 60% of those costs. An MV calculator is available at the site listed on this slide. Continuing from the last slide, we now touch on the issue of affordability. To be affordable means that an employee would not be entitled to any tax credit or other subsidy if the employer-sponsored plan provides minimum value and is affordable. Coverage is deemed affordable if the employee's required contribution for self-only coverage, which means not including dependents, does not exceed 9.5% of that taxpayer's household income for the taxable year. Again, the three main elements that are very important to an employer to be in compliance with 4980H is 1, that the coverage is MEC, 2, that it's MV, and 3, it's affordable. Continuing along with our basics to determine compliance with the ACA is understanding the concept of a large employer. The definition of a large employer with respect to any calendar year is an employer that employed on average at least 50 full-time employees on business days during the preceding calendar year. In subsequent segments, we'll uncover what's to be done with employers who do not have a preceding calendar year to rely upon and must use the current year as the determining factor. In addition to full-time employees, An employer must include the number of employees determined by dividing the total number of hours of service of non-full-time employees, also known as full-time equivalent employees, for the month by 120. Of note, a non-full-time employee cannot have more than 120 hours of service in a calendar month. An employer may be determined to be large if it is part of an entity with multiple companies. Each entity is referred to as a member. The calculation to determine large employer status. Take the number of full-time employees, including seasonal employees, for each calendar month in the preceding calendar year. Add to that the total number of full-time employees for each calendar month of the preceding calendar year and divide by 12. If the result is 50 or more, it's a large employer, unless the seasonal worker exception applies, which we'll discuss in a subsequent slide. As referenced on the prior slide, there are rules specific to employers who were not in existence in preceding years in order to permit them to determine their status as a large employer. To determine whether an employer not in existence in the preceding year is a large employer, we simply take the average of the number of employees that are reasonably expected to be employed on business days in the current calendar year. If an employer comes into business during a calendar year, say for example May 1st of 2014, during year one, the employer's status as a large employer is determined based upon the average number of employees that is reasonably expected will be employed on business days in year one from May 1st through December 31st. The employer's status in year two is determined by the number of employees that it employed on business days from May 1st through December 31st of year one, rather than relying on reasonable expectations for year two. 3-month grace period for first year as a large employer. If an employee is offered MV coverage by April 1st of the first year of a large employer, there is no assessment. If in year two, the employer falls below 50 employees and again increases to 50 or more in year three, there is no grace period. Seasonal workers and seasonal worker exception. When calculating employees to determine large employer status, consideration must be given to seasonal workers. The definition of a seasonal worker is someone who performs labor or services on a seasonal basis as defined by the Secretary of Labor, including but not limited to workers covered by CFR 500.20 and retail workers employed exclusively during holiday seasons. The seasonal worker exception, an employer is not considered to employ more than 50 employees if 1. The employer's workforce exceeds 50 full-time employees for 120 days or fewer during the calendar year, and 2. The employees in excess of 50 employed during such 100-day period are seasonal workers. For predecessor employers, the status of this under the law is still unsettled. This is the last slide in this first segment of the Holman HR video alert series on the ACA and the final regs. Stay tuned for another video alert focusing on an additional section of the final regulations. Of course, if you have any questions, please contact your Holman HR consultant and we'll be glad to be of assistance. Thank you.